the brains trust of Deutsche Bank with me. Ravneet Gill, the CEO, Rahul Chawla, the head of global markets debt, and the head of equity markets, Prateek Gupta. Gentlemen, thank you very much for helping us usher in 2017 with such a bang intellectual treat. Well, Ravneet, first up to you. While yes, it is a new year, over the weekend and over the week, the cues have been somewhat negative in the sense, first it was Ford, and then Toyota also has been told by Trump not to manufacture outside. The H-1B visa bill introduced. Is it all looking like the short EM, long DM trade is going to continue?
I think if you go back to the second half of 2016 as well, I think the presiding theme really was that you could see a reversal of flows from emerging markets back into the to the developed world. But if you see India's own flows, it hasn't really quite panned out that way. And I think we are living in an environment where you will see a lot more volatility. There's so much happening. If you look at India, you look at the world around us, you look at some of the political developments that happened in the rest of the world. I think really, to use a term which is now very common in terms of the new normal, I think that's pretty much what it is. But do we see a divide coming through with respect to this being again becoming a developed world story rather than emerging markets? I don't quite see it that way. I think even if you go back to last year, the first quarter was very turbulent, and then things eventually settled down. And I also think that right now we are at a slightly heightened level of sensitivity, relative to what's happened locally, which in itself I think has been broadly positive. It's just that the level of dislocation has been so high that we haven't been able to make full sense of it. But my own sense is that no, things are not as worrying as they may seem, and a lot of this political rhetoric will actually settle down.
Okay, well, I'll come back to you on what is really the FII view, especially with respect to India. But since you touched on, the demonetization as well, Prateek, over the weekend or just before that, we also got the GDP numbers. I know it's, extremely macro, but even with 7 months of data, the CSO has downgraded its forecast, or rather is giving you a forecast of 7.1%, half a percentage point lower than last year. Now if you factor in your GDP growth, if I remember right, Taimur was saying that it was 7.1 after taking into account. So now are you going to worry afresh about your earnings as well for the second half?
Well, I think firstly for FY17, the earnings estimates have anyway taken a hit after demonetization. Various sectors across the economy have been hit. So I think from an investor standpoint, they're anyway looking beyond FY17, and the questions are more around what will be the extent of the recovery in FY18. And there what we expect is, while FY17 you will see lower GDP growth, possibly lower than the 7.1% with the CSO saying based on the pre-demonetization estimates. But FY18, we think we should see a pretty strong recovery. Our economist expects 7.5% GDP growth next year. Our analyst team expects the index earnings growth to rebound to the 18-20% mark. And this assumes no extra stimulus in the budget which is coming up, which is another yet event. So I think investors are looking beyond the demonetization slowdown, which is already played out and priced in to a large extent in our view.
Okay, well, I will come to, where that 18% comes from, and I would assume that you'll have some budget expectations. But before that, Rahul, the 6.11 was the best 10-year yield, and then that got washed away. Now we are closer to 6.4. Yeah. Is fixed income going to give us much in 2017? Will we even go sub 6, or is 6.11 the best we will get?
Well, the view is that, coming to the fact that in terms of rate cuts, we still believe that there is an appreciable amount of rate cut ahead of us. We think that we have about 50 to 75 basis points rate cuts in the next sort of six months. We think it's going to be front-ended. In terms of treasury yields, we also today are factoring in a forecast for about 6.2. So we think that there is a trending of yields downwards. A lot of it has got priced in because the market has been flush with liquidity and people are anticipating. And the other thing that you have to keep in mind is the positive that could flow from here is the fact that the CPI inflation data could trend lower than the 5% that we had projected. It could come down to about 4.5, which would give adequate room for the government to sort of, RBI to think from a monetary policy, expansion point of view.
You know what, I was going to actually ask you more about budget being a stimulant. 50 to 75, you all are outliers. The best I've heard is 1 to 2 rate cuts. You're looking at 2 to 3 rate cuts. All of it coming in 6 months, you think? So first 3 policies of the year, or just in 2 policies of the year?
Well, our view is it could be 3. It could also get accelerated. They do want to have a quicker impact of trying to revive the economy. Clearly, the private consumption, needs to be revived as well, along with public spend.
So you would look at a lower than 6% yield on the 10-year in the first quarter?
Potentially. We are targeting a 6.2, but there is a certain upside if the rates cut tend to be a little more on the positive side upfront. If
it is 5.5 repo rate, then at some point it goes below 6?
Typically you would have a differential of about 50 odd basis points. So yeah, it could touch 6 definitely.
Okay, that's certainly a very optimistic view for a bond guy, but that also means a lot of pessimism on growth. Otherwise you won't get such big cuts. But Ravneet, on that issue, what are you hearing from the FIIs? While they have definitely deserted emerging markets in favor of developed markets, India has been deserted a little more. But are you getting a sense that this will turn sometime soon? What's the in-house view?
So I think if you look at the FII view, it gets reflected also in terms of how the rupee has performed. And if you look at the emerging market currencies, rupee has definitely been one of the better performers, which would tend to suggest that the view on India remains positive, remains constructive. I think if you look at all the emerging markets right now, and you look at it from a growth perspective, from a fiscal consolidation perspective, you look at the twin deficits, I think India really still stands out. The question is that nobody saw demonetization coming. And if you see an economy where cash to GDP is 14%, which is effectively the highest, even if you see the comparable EMs like Brazil or South Africa, they're at 4 and 5, I think the level of dislocation has been huge, and people have still to make sense of how long could the impact of this be. Now the question really is that my own sense is that in 2 quarters India would have digested this, and you will start seeing a stability return to the system.
So FII flows is not there for 2 quarters, you think?
No, I don't think so. I think FIs will remain engaged. Right now it's very difficult to make calls with regard to how quickly demand will come back, what earning growth will be. But if you look at it at a philosophical level, at a broader macro level, what is 6 months in the life of a nation? So yeah, it's 2 quarters of earnings, and obviously analysts get driven a lot by that. But come to think of it, our generations always complain that India only believes in incrementalism. So if India takes a step which is really large, substantive, transformational, I think we need to see it in that context. And did the system need to be cleaned up? Was the cleansing required? To my mind, if you see the performance of this government, this is the first real expression of Swachh Bharat, of cleaning up India and the cleansing. And I think even though people keep talking in terms of all the cash having come back into the system, it's come back now into the real economy, and it's in the formal economy. And the impact this will have with respect to tax collections and more productive, our saving rates being more productively channelized. Absolutely. So I see it as a positive all the way through, and I don't think that the FI view is very different from that.
Okay, well that's a positive. We need to take a break, but really the substantive questions are now, since you are expecting a big manna for the fisc, as well near term a lot of earnings downgrades. Which sectors? At the moment the markets are giving a thumbs down for the IT, but a thumbs up for banks. So those specific questions to the DB team in a minute after this break.